Asset allocations and diversification. Asset allocations and diversifications might seem similar, but in reality, they both are different. Today in this video, we will talk about them and how they are diverse, influential, and everything. So, without further ado, let's begin with the video. Asset allocations and diversifications can assist you in striking the proper risk-return balance in your portfolio. In addition, having a diverse portfolio of investments can help mitigate the impact of any single economic or market event on your portfolio. This is because different investments gain and lose value at different rates and times. The different weightings of stocks, bonds, and cash in your portfolio are referred to as assets allocation, because these three assets classes have historically had varying rates of return and risk profiles. Asset allocations can assist you in meeting your investment objectives. Diversification extends this process by spreading your money across various investments within the same asset class. So rather than predicting which type of stock or bond will perform best, you will invest in multiple of them. As a result, the ups and downs of one investment have the potential to balance out over time to lower the risk level in your portfolio, adapting to changing market realities. So what has changed? If anything, during the Great Recessions of 2008, globalization has made markets more vulnerable to external shocks, resulting in increased volatility and stronger correlations between asset classes. This surprised investors who expected different asset classes as they held to zig while others zagged. Instead, they found that when one asset class zigged, the others zigged as well, or zagged by a much smaller amount. This is not to say that diversifications and assets allocations did not work. They did not provide the level of protections that was hoped for. If anything, this experience demonstrates that asset allocations and diversifications are more crucial than ever. Market volatility only emphasizes their significance. The relatively reasonability of low-cost non-traditional asset classes can benefit. Real estate, commodities, treasury, inflation-protected securities, and international bonds have historically had low correlations to traditional asset classes, so adding small amounts to your portfolio can increase diversifications, potentially lowering your investment risk over time. Of course, your circumstances and investment preferences determine the exact amount you use. Diversifications cannot always protect you from short-term market declines. Still, it has historically been an excellent defense against long periods of poor returns, which can be far more damaging. So it is still a perfect strategy. So that's all with today's video. Let us know your views in the comments below. Until the next video, stay tuned and subscribe for more.